Here's a clear guide to tax on pensions, from allowances to lump sums and tax codes. It also covers savings, dividends, and side income. No fuss, just the essentials. Most people want to know what really happens with tax on their pensions once money starts coming in. And the short answer is that pension income is taxed like other income above your personal allowance, with the details depending on the type of pension and what else they earn. The clearest starting point is total income. State pension, workplace pensions, and private pensions all sit alongside earnings, rental profits, and other receipts to determine the final bill. If that total rises above the personal allowance, for many people, £12,570, the excess is taxable, and providers usually deduct tax through PAYE using a tax code. The familiar rule on taking a pension lump sum still applies, with up to a quarter typically tax-free within the individual lump sum allowance framework. At the same time, the remainder is taxed at the individual's marginal rate. Timing withdrawals to fit tax years can help keep rates sensible when planning the tax on pensions. The interaction with work can be surprisingly simple, as an employer and each pension payer can use different tax codes, and HMRC adjusts these to reconcile the amounts received. Someone who is self-employed and receives retirement income may still need to file a self-assessment return to capture trading profits and settle any outstanding balance due. The way savings and investments sit alongside retirement income matters, because interest from bank accounts can fall within the personal savings allowance or the starting rate for savings. Dividends have their own dividend allowance and rates, and ISA income remains tax-free. Additionally, buying and selling shares can also lead to capital gains tax if gains exceed the annual exemption, which should be considered alongside the tax on pensions. The system handles common scenarios with minimal effort. Pension providers operate PAYE, and HMRC may issue a simple assessment when tax cannot be collected automatically. For example, this may occur when the state pension pushes someone over their personal allowance, or when more than £3,000 is due in a tax year. HMRC will then send a letter explaining this assessment, outlining the amount to pay and the payment method. The seasonal winter payment brings a twist because those born before the 22nd of September 1959 can receive it automatically. And if total income exceeds £35,000, they'll need to pay it back, with HMRC recovering it via tax codes from 2026 to 2027 at roughly £17 a month for a typical £200. This increases to approximately £33 a month in 2027-2028, before easing back the following year, if applicable, or being included automatically in the 2025-2026 self-assessment for those who file online. The household balance sheet also changes over time, so notifying HMRC about a new address, a name change, or a move abroad keeps records accurate. Moving overseas, working full-time abroad for a full tax year, or leaving the UK permanently can change UK tax status and can also influence how the tax on pensions is collected. The broader picture includes life events and assets. Bereavement can alter income streams and entitlements. Inherited property or investments can create income tax and capital gains issues. And downsizing a home is usually free of capital gains tax if it is the only or main residence, whereas selling another property may trigger a charge, which sits alongside the tax on pensions when budgeting. The practical approach is to review codes on payslips and pension statements, cross-check the figures in a personal tax account, and monitor savings interest, dividends, and disposals to avoid unexpected bills. Making small adjustments during the year is far easier than large corrections later on, which aligns gracefully with the tax on pensions. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about tax on pensions, then do call me on 01908 774 320 and let's see how I can help you. Don't forget to stay updated with our daily social media posts on Facebook.